today's topic, which is trading versus investing. So we will we'll tackle that. This is just a comeback, after a long time of being away. This is just to reintroduce the webinars and probably see what your expectations are, what your suggestions are, and what we can do better. So last time we talked about how to pick stocks, more so screening, how to identify stocks, how to use tools like Finviz, tools like Bazinga, and other platforms to decide if you're going to buy a stock or not. We talked about a little bit about the technical analysis, how you use support and resistance, and other indicators, like moving averages, there's volume indicators or RSI, relative strength index, how to use all that to decide whether, the stock is at a good point to buy or not. So, for the most part, we've just been talking about finding stocks and looking at stocks, trying to see which one is good to buy, which one is not, when is the time to sell, when is the time to buy. And for the most part, you realize that we haven't talked about the trading strategies. What is your strategy when, yes, you've looked, you found a stock, you're trying to figure out, this is the one I want to buy, but what is your strategy? What is your end goal? What is your plan? I'm buying this at this price, this is my entry, this is my exit. All that is in, yes. But what is your end term goal? What is your end goal when it comes to why you're buying that stock, or what is your plan at the end of the day? And that's where I thought, you should at least know, are you going to trade or are you going to invest in that stock? That's why the topic today is about trading versus investing. And the reason as to why that is because these are two different things. Trading and investing are two totally different things. People know, when you buy something, you're trading. You buy, you sell, that's trading. So when you go and buy a stock and you sell the stock, that's also considered trading. But when does investing come in? When does investing come in? How do you differentiate you buying a stock today and saying you're trading it, and you buying a stock today and say you're investing in that stock? Okay, so there's a big difference, and part of that is the reason as to why you're buying that stock. So trading for the most part takes time. Not trading, but investing. Okay, so trading for the most part is short term. The difference between trading and investing is trading for the most part is short term. Okay, when you're trading, you want to buy and sell probably within the same day. And there are other trading strategies that will probably take a few days or will take a few minutes, but generally speaking, trading is short term. You're in, you're out, you made your profit, you're gone. Okay. Trading is also common when it comes to buying commodities. So you're buying oil, gold, silver, copper. If you've traded, you traded forex, those mostly is trading. And for my friends who are into cryptos, trading cryptos is a thing. You trade cryptos. For the most part, most people don't invest in crypto. You buy today, you want to make your 10, 20, 15, 30%, then you're out. Most people don't go and buy, let's say, Bitcoin and say, I'm going to buy Bitcoin and invest in it and wait until it gets to this price, or wait until it goes to this level. Majority of people trade cryptos for the short term goals, which is, I want to buy today, sell it by the end of the day, or sell it by tomorrow, or sell it within the next few days if it gets to this point. So trading is mostly short term. Trading is mostly confined to stuff that is more liquid, stuff that you want to buy today and sell tomorrow, kind of thing. You want to buy within the day, and by the end of the day, you've sold it, or you've bought and sold several times within that day. On the other hand, investing is, you're more concerned about the long term. You're more concerned about growing your wealth, longer time frames. You want to buy a stock today because give it 5-10 years, this stock is going to be 200-300% growth. Yeah, that's what you want to do. You want to hold it for a longer time frame. You want to keep it there, and you trust that it's a good company that will grow significantly over time. So investing is, you're putting your money steadily into a stock, knowing that over time this stock is going to grow, and the money I'm investing in this stock will probably double, triple, over a time frame of like 2, 3, 4 years. So you're not in a hurry to make the profits today and get out today and enjoy the benefits you've gotten from that stock. So investing is a time-oriented affair. You want to take your time. If you're investing in stuff like you're investing in your retirement account, I'm going to retire the next 20, 30, 40 years. You're taking that time. You're not concerned about what's going to happen tomorrow, what's going to happen next month, or what's going to happen next year. What you're doing is you're investing in that program because my goal is to retire in the next 20 years, in the next 30 years, and that takes time. So the small fluctuations in the market right now, those don't bother you. You have a good stock, you've done your fundamental analysis, and that's where the difference between investing and trading comes in. With trading, all you want to know is, can I make 10% today? Can I make 5%, in the next 5 minutes? Can I make 100% within 24 hours? That's trading. But with investing is, hey, I'm going to make probably 1,000% in the next 5 years. So you're not concerned about the 10, 20, 15, 30% that you'd probably make today or within the week. So investing is more long-term oriented. You're looking at a financial goal that takes time. You're not concerned about short-term gains, and you're more inclined to worry about market fluctuations and all this news that is going on, like right now with inflation, with hiking of the interest rates by the Federal Reserve Bureau. A lot of things are going on that for an investor doesn't really change a lot for them. You're in for 5 years, you're in for 10 years. What happens this year doesn't really matter. the only thing you can do probably is restructuring your portfolio and maybe buy something else that has dropped today. You know, you're buying mostly when they're cheap because you know given time they'll grow. But with trading, it's a short term, it's you want to make profit right now and all that. Now, let's go back to trading strategies. So because trading is short term, there's different strategies that are employed with trading. The most common one is usually day trading. If you're a day trader, you know you're buying it today, and before the end of the market close, you know, before market close, you're selling your stock or whatever you've bought, whether it's crypto, whether it's forex, whether it's a commodity. You're buying it today and you're selling it before the close of the market. That is the end of the day. So that is one strategy when it comes to trading. There's day trading. You're only concerned with what you're going to make within that day. After that one day, you close your trade, whether you're in profit or you're making a loss. You've done that, you walk out, then you start again tomorrow. The second trading strategy is the swing trading. So with swing trading is you're buying it today and you want to sell in a couple of days or so, or up to a week, you know. So you wait for the swings to happen. They call it swings because there's ups and downs. Now, if you're looking at a weekly time frame, you realize the whole time frame, there's ups and downs, ups and downs, ups and downs. Those are called swings. Now, you know, if you buy today, the swing is going to take probably 2 days to go up, or the swing is going to take 5 days, or the swing is going to take 2 weeks. Now, you buy knowing that my time frame for this trade is 2 weeks, my time frame is 2 days, my time frame is 5 days, or whatever it is, and then you wait for the swing to happen. You find a stock when it's down, you know this will go up in the next few days, then you buy, and then when it goes up within those few days, you sell. So that's called swing trading. So swing trading can happen within 2 days or more. So sometimes up to maybe a couple of months. But for the most part is short-term swings, not long-term. So you're doing, 2 days, 2 weeks, maybe maximum 2 months. So that's the second common way of trading. And the third way is what we call scalping. So scalping is, think about a surgeon with a scalp. When you're doing surgery for surgeons, is you're cutting off maybe a section of, say if you're doing surgery on a cancer patient, you use your scalp to cut off the cancer or cut off, a section that maybe it's causing issues to the patient, or you're cutting off, you're cutting a small section to do the operation. So just like just like scalping in the medical industry, scalping in trading is you just want to cut off a small portion of the profit that you can make within a short time frame. So scalping happens in minutes, and sometimes you can do it in seconds. There's scalpers who use algorithms and softwares and robots that you go into a transaction or a trade, and the robot can do that in milliseconds. So the moment the stock moves up even 2 cents, it closes that trade and opens a new trade, and it does that automatically. But for people usually do it in minutes. So 2, 3, 4 minutes, sometimes 15 minutes. But all you're doing is you're coming in when the stock is probably going up, and then if you look at let's say 1 minute time frame, you realize from here to there is going to be maybe 20 cents. You come in, you buy, it makes 20 cents, you sell, it drops down a little bit, you buy, it makes another 20 cents, you sell, it drops down a little bit. As the upward trend is going, you are buying and selling, buying and selling, buying and selling at the same time. So that's scalping. You just take small portions in short time frame, very short time frames of a minute to 15 minutes, most probably. So that needs you to be to be trading in stuff that move very fast. Stuff like cryptos is good to do scalping on cryptos. It's good to do scalping on forex, and sometimes it's good to do scalping on what we call penny stocks. Penny stocks are stocks in the U.S. Stock market that are trading below $5. So when you are scalping a penny stock, you come in when the stock is probably 90 cents, maybe $1.57, right? It goes up. There's usually big swings when you're scalping. So something comes from, say, $1.57 and goes to $2.50. You're probably making like $1 difference there. You scalp that out. That's your profit you've scalped out. And then it drops down a little bit from $2.50 and it goes back to maybe $2. Then you buy again. And then it goes back up to maybe $3. You make another $1, you scalp it out, right? And you keep doing that until that stock goes from, let's say, $1.57 to probably like $10. You're just doing that, and that can happen within an hour. So in an hour time frame, you've scalped that stock probably 5 times or 6 times. And then once the momentum goes down, you're already out. You go to another one that is doing almost the same thing, scalping up and down, up and down. So that's the third way of trading, which is scalping. Now, the other one, which is not very common, is called position trading. So you hold a position in a stock, and that position, you've done the math and realized, if I hold 100 shares of this stock and this stock moves 20 cents, I can make, $20, something like that. So you take a position in a stock knowing that all you want is for the stock to move a certain distance, and you make your profit. And then once you've done that, you exit that position, and then you hold another position in a different stock. And this could happen, in hours, days, weeks, or even a year or so. You just hold a position in a stock, and your expected profit out of that position. So that's the fourth option, which is not really so common, but for the most part, it could be confused with swing trading. But with the position holding, is you're just taking a position in a stock with an expected growth. Then once that expectation is met, you're out. And the last way of trading, which kind of ties into all these other forms, it's not a strategy, but it's just a way of trading. Most people, when you're buying a stock, you're buying it when it's down, you're selling it when it's up. And for the most part, when you're trading stocks, you're buying. That's what most people know. You're buying so that you can sell. But the other way of trading is called short selling. So short selling is the opposite. You sell and then you come back and buy when it's a lower price. So you find something that is, say, $10, then this thing is going to drop 20%. And if it drops 20%, you'll make your profit that way. So you sell when it's at a higher price, and you buy when it's a lower price. And this is how it happens. So your broker, once you met the requirements, your broker says, now you can short sell. What that means is your broker is willing to lend you those stocks right? They give you stocks and they tell you, okay, take these stocks, you can sell them to anyone you want, but within a certain time frame, or within, whatever period, I want our stocks back. So we are loaning these stocks to you for you to sell to whoever you want at whatever price. We don't care. But when we need that stock back, we need you to reimburse them. So we're giving you 10 stocks, we need 10 stocks back. We're giving you 100 stocks, we need 100 stocks back. So short selling is the broker gives you a loan in terms of stocks, you sell the stocks, and then once you've made a difference, that is a stock that came from $10 is now $5, you've made 50%, then you come and buy the stock and say, now I'm refunding this stock to the broker after they had given me the stocks to sell in the first place. So short selling needs you to have what we call margin, and margin is broker says, I'll give you a loan in terms of cash for you to do this, because you cannot do this with, maybe $1,000 or less. So because you only have $1,000 in your account, I'll give you more money so that you can be able to now short sell some of this stock. So let's say you're buying a stock that is $20, but you're short selling a stock that is $20. And then for you to make profit in a short time frame, you'll probably need to buy 500 shares of that stock. So 500 shares and the stock is $20. That means you're probably doing a transaction worth $10,000. Now you realize your account is only $1,000, and you're trying to make a trade worth $10,000. This is where your broker says, you know what? You want to buy 500 shares, it's going to cost you $10,000. You don't have $10,000, but I'll give you a loan. I'll give you a loan so that you go and make this transaction. But remember, you're only making profit on the $1,000 that you are putting into the trade. Like whatever profit you make, that's your profit. But we need our money back, and because you're short selling, we also need the stocks that you're short selling back. It's like we're renting them to you. We rent it, you go sell, you do whatever you want, you bring them back. So short selling is full of risk, and this is why stuff like cryptos and forex, a lot of people lose a lot of money because of that, because of leverage. Leverage and margin is the same thing. So the broker gives you margin or leverage to make these trades. So when you're making these trades in forex and cryptos, if you're not careful, you'll probably lose all your money, because the money you've invested into that transaction is so low compared to what the broker is offering you in terms of margin or leverage. And then if your transaction doesn't go as expected, that is, maybe you're short selling a pair of forex, for example, of which it still happens with stocks, but it's most common with forex and cryptos. So if you are short selling a stock or a crypto, and then you're expecting it to go down, but instead it goes up, now you're making losses. And you're not just making losses on, say, $1,000 that you've invested, but you're also making losses on the $10,000 that your broker gave you, or $9,000, to add it up to the $1,000 to make $10,000. So for the most part, the broker realizes that you're making a loss, and they say, you've made enough loss, I think it's time for you to get out. They give you a warning, which is called a margin call. When you receive this warning, you need to close your trades and take the losses. Otherwise, if the losses continue happening, the broker then decides to close the trades on your behalf, because they know we've invested $9,000 in this transaction, and you are not making the moves to mitigate the losses. So we will exit it for you and call it a day. So that's how most people lose a lot of money in Forex and cryptos, because at the end of the day, you're trading someone else's money more than you're trading your own money. So that's more so about trading, which is more risky, more complicated, more active. You need to be an active trader. You need to be more involved. You need to do a lot of things to be in that kind of trading or investing way of doing things. Now, when it comes to investing is the opposite of that. Is less risky. You just taking your time. Like I said, you are looking at a longer time frame. You're buying stocks maybe periodically every month. You're depositing your $1,000, $500, $200, and you're buying a stock like Microsoft or Facebook, and if I give it 2 years, 3, 5 years, 10 years, this stock is going to go up 1,000%, 1,500%. So I'm not worried. I'll keep buying slowly over time, and eventually I'll end up with 1,000%, 3,000%, whatever. So unlike trading, investing is just straightforward. It doesn't have strategies as such, even though we've come to realize there's other things you can do with investing. So with investing is just straightforward. You buy a stock, you hold it for a long time, and you make your profits over a long time frame. It's not time consuming. You can buy today and sit and wait for 3 years, come back, and you realize the stock that you bought at $20 is now at $500. You can buy today, and 2 years down the line, you realize the stock that you bought at $20 has gone to $150, and probably you've had something on the news that this company is probably going to collapse or whatever. Then you go and sell the stocks before the collapse. You've made your, what is that? 150 out of 20 is around 700%, 750. You've made your 750% in 3 years. The company is not performing well. You sell your stock. Then you go buy another one that you're going to hold for another 2-3 years again. So it's just that simple. You buy, you wait, you make your profit, you exit, you do the same thing over time. Now, there's other goals that you might have when you're investing. So let's say you're investing for income. That means you're specifically targeting a specific type of security, which is something like ETFs and dividend stocks. Dividend ETFs and dividend stocks. These are the ones that pay you dividends over time. So when you're investing in for dividends or for income, you have to buy dividend stocks, and you have to now know, okay, how much dividend or how much income do I want in, let's say, every month. So your investing strategy should look into which stocks give dividends at which time frames. And for the most part, most stocks do it quarterly. So every quarter they give out dividends. Every quarter they give out dividends. But you realize there's other ETFs like dividend ETFs that give out dividends every month. You realize there's other ETFs that give out dividends every 6 months. So when you're putting up your dividend portfolio, your income portfolio, for that sake, you're choosing specific stocks and ETFs, and okay, this is going to give me dividends in January, and this is going to give me dividends in February, and this is going to give me dividends in March. You do that so that you spread out that dividends across the year, and you're targeting maybe you want 100K a month. So for me to achieve that, I need to put in $1,000 into this dividend ETF that gives me dividends every January. I have to put $1,000 in this ETF that gives me dividends every March, or if you're doing quarterly, everything is quarterly, every quarter I'm getting 200K or $2,000 in dividends, but I'll need to invest maybe $5,000 in this group of ETFs and stocks that pay me every quarter. And that means every 3 months you'll be having like 200K, which if you look at that per month is like 60K. So you have to do that math and realize, okay, for me to get 60K every month, I'll have to invest in these ETFs that give me a certain percentage of dividend yield. And over time, every 3 months, I'll be getting 200K in total. Then I can spread my expenses, because that's your income. You spread the expenses over the 3 months time frame, so that when you get your dividends in March, then you spend those dividends from March, April, May, and June, and then by the end of June you get another set of dividends. Then you spend that until like September or something like that, and then you get the last set of dividends in December. So if you do that, you realize you can have consistent income, and you know what, everything else done and said, I'm okay, my income is good, my dividend portfolio is okay. And if something, say one of those stocks or ETF is not performing well, you just go and swap it with another ETF that will replace it and give you the same performance. So with investing like that, you have the benefits. You know you are getting income. With stuff like retirement accounts, I'm investing in ETFs and all these that will give me, let's say, 20% or 18% annual growth. And if you keep investing in that over time, you realize maybe your total investment is like 1 million Kenya shillings, but after 20 years or 30 years, your 1 million Kenya shillings of investment has grown to probably 50 million or 100 million, depending on how much you've structured your retirement portfolio. So with investing, is more of in-depth. You look into the details, you try and see what is your expectations over that time frame, because you're doing this for 5 years, for 10 years, for 20 years. You want to know what is your outcome, what is your expectations, and with that you can start putting in the measures to make sure that you achieve those outcomes. And then over time you modify this plan by either changing the stock to a different one, or changing the ETF to a different one that gives you better performance. And also put in stuff like dividend reinvestment plans, which is if you're investing in a dividend ETF on your retirement account, the dividends you earn gets reinvested in the same ETF, and the cycle keeps going on. You keep building, you keep growing your wealth over time. So if you want to grow your wealth, you probably are interested in investing more than trading. So, or you employ compound interest. It's a whole process, but it takes time. You compound maybe at 10, 20, 30%. Give that 10 years, 20 years, your compounding grows to probably 1,500%, 2,000%, which is insane. Now, I think we are almost coming to the end of the webinar. I wanted to show you something that will probably make you see the difference. This right here is for those who are who can watch or see the on the video. What is this? So this is Facebook, and Facebook came into the stock market in this is 2012. I think it's in 2012, around May of 2012. Now, Facebook came in at $20, where the IPO was like around $37, but it dropped to $20. So, if you had invested in Facebook at $20 back then, it has grown. Maybe back in 2012, you buy Facebook, and up to September of last year, Facebook had done 2065% in growth. Okay, 2065%. So imagine you are $20, with that 2000%, that is 20x. Plus 1 times $20. So your $20 would have grown to around $433. So imagine then. If you had let's say $1,000. Okay, you had $1,000 into this. Your $1,000 would have grown to around $21,000. That's how investing makes a difference. You're not worried about what was happening here in 2013, or what was happening here in 2014, or here in 2015, or here in 2016, or here in 2020, or here in sometime back in 2020, or here in 2021. You're not worried about that, because you invested when it was $20, and over time you probably had made $400 in profit plus. So when you're investing, this is the advantage you get, because you're not worried all this time. You're not worried. Other strategies you can employ when you're investing is, when a stock drops, like the drop of 2020, you buy more if you have the money. Even right now, look at Facebook. From a high of 386 to now, it's trading below 200 for the most part, 189 current price. This is a huge discount for a company that probably might grow even more back to 400. Yeah. So if this company grows from where it is 189 right now, 189, and it goes back to the 380 something, 86, that's 100%, just like that. Yes, when you look at the drop, you might think, that's nothing, it's not a huge drop. Yes, it's 50%, but to go back to break even for someone who was up there, it will take you around 100% growth. That is, it has to double to get back to where it was. At least double. Now, if this happens, you're buying Facebook here and it doubles, it goes back to here, you made your profit. But then, what if it go? Over time you realize, okay, Facebook is now at, let's say 600. So you're coming from here, and then Facebook goes to 600. That is 200 and something %. So compounding will help you with this, will help you grow your money over time by investing long term. You just buy the dips like that. You buy the dips like this one. This is a huge one, very huge discount. You buy this, it keeps going up, you make profit. Good for business. You'll thank yourself 5 years later or 10 years later when everything else changes. So that's all I could say about the topic today. That when you're putting money in your account and you're saying you want to invest in the stock market, you have to specify what are you doing. Are you trading or are you investing? If you're trading, then you have to employ all these strategies. And on top of that, trading needs you to have a lot of money because one, you want to buy a large portion, large number of shares and sell them within a short time frame. I think I should go back to that Facebook. Within a short time frame. So let's say this is Facebook and we are looking at 1 hour time frame. With 1 hour time frame, okay, every candle here is 1 hour, and now you want to trade Facebook, but you want to come in here and exit out here, for example. So you come here, you exit out here. That is 8%. Now it's modest, is okay, but you're realizing that with this, let's say you want to make a profit of, let's say $200 on that trade. $200. $200 is 8%. So how much do you need to invest to make? So, like you can see, $2,500 for you to just make $200. It's a lot of money. You just don't say, I'm going to day trade Facebook and make $200 without that 2,500. Now you can go to cheaper stocks, like this is the penny stock, and you want to buy this penny stock. This penny stock is $2. You want to buy, let's say you are here, you want to buy it at $3.47, and you want it to go to where it went to around here. That's 11%. Now 11%, which is 385, 3.85 minus 3.45, that's a 40 cent difference. Now if you want to make $200 on this, so it's $200 by that, you need to buy 500 shares. 500 shares of this. Now you want to get how much is it going to cost you at around 345 cents. It's going to cost you around 1,725. Now you realize for you to just make $200 on this in profit, you'll need around $1,000, 1,700. That's where trading becomes expensive. Trading needs you to have a lot of money. But on the flip side, investing needs you to have a lot of money, but or spread over a long time frame. With trading, you only need that money like in the next 15 minutes, or in the next 1 hour, or in the next 4 hours, or within the day. But with investing, you can start investing $50, $100, $200 slowly over time, and by the time you get to $2,000, your $200 that you started with has been compounding over time. Your $1,000 that you started with has been compounding over time, and before you know it, by the time you've reached, say, a total investment of $5,000, it has taken you maybe 5 years, and your overall account has grown to probably $15,000. So investing is slow, it takes time, there's no growth you'll see at the beginning of your investment curve, but once you start having that compounding effect happening, it's going to be a huge trajectory, and it's going to send everything up. So when you're choosing what you want to do with your money in terms of getting into the stock market, choose which method works best for you. If you want to trade, no, you'll need a lot of money in a short time frame. And if you want to invest, you'll need a lot of money in a long time frame. If you want to invest, if you want to trade, you'll be probably incurring a lot of losses because you are venturing into a very risky affair. But if you're investing, a company like Facebook can drop 50% today, but it can recover it in the next 2, 3, 4 months. So each and every one of these has an advantage and a disadvantage, but it's up to you now to see what is your goal, what is your expectations, and what does it take to achieve your goal. So with that, I'll call it a day for the topic, and I'll open the floor to questions. If anybody has a question, let us know and we'll discuss that.